Good afternoon. My name is Peter Chang. I'm with Computershare Governance Services, and I'll be your host for this webinar. Today's session is the second in our joint webinar series with TMF Group on doing business in foreign jurisdictions and the global risks in entity management. Our discussion today will focus on doing business in India. We also have upcoming sessions in June on doing business in Brazil, and you may register for that webinar at cgs.computershare.com. For those who missed it, we also hosted a very interesting webinar last month on doing business in China, and you can actually watch a recording of that webinar on the Computershare YouTube channel. You're invited to send in your questions throughout today's webinar via the chat feature in WebEx, which you can see in the lower right-hand corner of the screen. We'll aim to keep today's session to about 45 to 50 minutes, and we'll try to answer as many questions as we can at the end of the webinar. Before I introduce our speakers, here's a quick look at some of the items that we'll be covering in today's session. We'll look at the current developments in India and why it's been so attractive for foreign investment. We'll look at the different available entry options and regulatory issues for incorporating in India. We'll also talk about some of the real-world challenges that a company like Jones Lang LaSalle has faced while doing business in India. Finally, we'll look at how companies can manage these compliance concerns and to mitigate these risks. So let's begin. Our speakers for today are Nitin Shingala from TMF Group, Jane Niven from Jones Lang LaSalle, and Beth from Computershare Governance Services. Nitin is currently Regional Director for India for the TMF Group. He leads a team specializing in providing tax, accounting, financial support, and related outsourced services to international companies operating in India. Nitin was previously the Finance Director for IDEX Corporation and ran his own firm for 17 years before merging with TMF Group. He has also written for several financial newspapers on tax and compliance in India. Thanks for joining us today, Nitin.
Thank you, Peter. Good afternoon, everyone.
Jane Niven is currently Regional General Counsel for Jones Lang LaSalle. She's the Head of Legal and Compliance in Asia Pacific, managing legal issues for TMF Group across 13 countries. Jane has lived and worked in Asia for over 20 years and regularly speaks at compliance and anti-corruption conferences in the region. Glad you can join us, Jane.
Thank you, Peter.
Beth is currently Manager of Business Development for Computershare Governance Services in EMEA, managing the compliance suite of governance products at CGS, including entity management and corporate board portal software. Over his career, Ian has been involved in governance engagements at hundreds of Fortune 1000 companies. Thanks for being here, Ian.
Thanks, Peter. Hello, everybody.
So, without further ado, let's talk about doing business in India. Please take it away, Nitin.
Thank you, Peter. Let's start with a few interesting facts about India. As you could see different colors on the map, those are different states that India has. Being a federal republic, it has a central government and 28 state governments. That makes compliance a little more interesting. With a total area of over 3.3 million square kilometers, it's the 7th largest country in the world, slightly more than 1/3 of the size of the US. India has 22 official languages and over 800 dialects, which speaks for its vastness and diversity. The ancient culture is evident from the fact that world's first university was established at Takshashila in India around year 700 BC and attracted students from faraway places such as Babylonia, Greece, Arabia, and China. India is also considered inventors of number zero and the game of chess. English is the most important language, and approximately 350 million can read, write, and speak English. And it is the de facto language of business in India. As you would see, even in today's difficult time, India continues to achieve 5% plus growth in its GDP. So let's understand some of the factors that drive such interesting, very attractive rate of growth. India comprises of a young and restless society with 50% of its population below the age of 25 years. And this demographic dividend is expected to continue and propel growth over the next few decades. Technology over the last decade and a half has been increasing awareness as well as aspirations, and that has been increasing reach of the middle class. Examples are its mobile user base, which was around 37 million in 2001, has now increased to an astonishing figure of over 800 million. and it's world's second largest. The reach of television has expanded vastly, with over 800 TV channels being programs in about 30 languages. And India has now third largest internet population in the world after China and the US. Above factors have led to a thriving market, not only urban but also rural and semi-urban. Many leading brands have come to India and have become very successful. While Indian curry has been ruling rest of the world, India has been swarmed by Italian, Mexican and Chinese fine dining, as well as Big Mac and KFC. Interestingly, as a part of localization, KFC and Pizza Hut have set up vegetarian outlets in India, only place in the world where they have done so. Another interesting trend is frugal engineering, driving innovations which have emerged because of the shortage of resources that India has been facing all these years. There are many examples. I would just like to cite a couple of. A car under 2000 Nano by the house of Tata Motors, which incidentally now also owns Jaguar and Land Rover. A tablet costing just about $35. A green ATM by an Indian company with 90% lower power consumption compared to conventional alternatives. It can run on solar power as well and cost just 1/3. There are several examples. The automotive component industry in India is now very well integrated with the global automobile industry supply chain link. And a large majority believes that above factors will continue to drive India's growth story despite apparent challenges on the governance front. And that is the result why in UN CTAD World Investment Report of 2012, India is placed at third most favored destination after China and US. So fundamentals intact, and it continues to remain driving force in India. Peter, next slide, please. Now we look at some of the statistics on the foreign direct investment in India. FDI in India continues to be robust at around $34 billion in the first 11 months from April 2012 to February 2013. As you will see going ahead also, India follows April to March as financial year. In terms of cities, Mumbai has reported highest FDI, followed by Delhi and Bangalore. Last 12 months have seen several initiatives on government's part to further liberalize FDI in sectors such as retail, which we'll discuss in detail later. A large number of global investors and funds have come in via Mauritius. That's why you see in terms of number of countries, in terms of the source of FDI into India, Mauritius is at top at 38%. Obviously, most of it has come from other countries. And UK remains a very attractive place at third position. India has operational tax treaties with over 85 countries. So while the countries such as Mauritius and Singapore remain attractive for FDI into India through tax, because of the tax benefit in respect of capital gains largely, India has been tightening some of its tax rules, and recent amendments make it mandatory for foreign companies to submit tax residency certificate to claim tax benefits. Some of the very interesting recent FDI investment headlines are, just about 10 days ago, Unilever has announced additional investment of $5.4 billion to hike its stake in Indian arm to 75%. IKEA's application to government to invest over $2 billion in coming several years has been approved. Swedish fashion major Heinz & Mauritz has applied for investment of about 100 million euros to open about 50 stores. Etihad, an airline from the Gulf country, has made an open offer to acquire stake in Indian airline called Jet Airways. By investing 600 million, that will give them 24% stake. Another interesting fact is India has also seen significant outbound FDI, and leading examples again are Tata's having acquired JLR and Chorus Steel, and Mahindra, the house of Mahindra, having acquired Sangyong in Korea. Next slide, please, Peter. Coming to the brass tacks of entry options in India, any any foreign company wanting to do business in India requires a prior approval. However, it is possible to do business without establishing a legal presence, which is through agent, distributor, or franchise. As soon as a foreign company wishes to employ any employee in India, it requires legal establishment. While India has watered down its foreign exchange controls and regulation, it still retains controls in respect of cross-border business establishment and capital account transactions. These regulations are administered by Reserve Bank of India, or RBI in short, which is India's central bank. A foreign company requires prior approval from Reserve Bank of India to set up a liaison office, which is usually a rep office or a branch office or project office, except while setting up a branch in a special economic zone or a qualified project office. RBI takes about 8 to 12 weeks for granting approval and has stipulated conditions of minimum net worth and profit-making track record in respect of such establishment. In case of foreign companies operating in sectors that require government approval under FDI regulations, RBI forwards the application to government in turn before granting the approval. So as a result, the process to set up a simple establishment of a liaison office or a branch office can take more time at times as compared to setting up a wholly owned subsidiary in India. A liaison office is permitted to carry out a very restricted list of activities which have to be of non-income generating in nature, such as representing parent company, promote export or import from to India, or promote technical or financial collaboration, and largely act as a communication channel. Every liaison office in India is required to submit prescribed annual statement to the tax authorities, in turn detailing various activities carried out within India, and is subject to intense scrutiny from tax office in case the activities transgress the limitations placed under the foreign exchange regulations. A branch office is permitted to carry out limited income generating activities such as import or export of goods. So physical import or export of goods is permitted. A branch can have stock in India and raise invoice from India. It can carry out professional or consultancy services. It can carry out various other services such as IT, software, technical support. Withholding tax implication at over 40% and risk of permanent establishment are some of the impediments in establishing or doing business in India in the form of a branch. A project office does not require any prior approval, and a foreign company can straight away start a project office when it has secured a qualifying project, which has to be funded through foreign exchange or by inward remittance, or it has to be funded through multilateral international financing agencies such as World Bank, and a couple of other windows which make it possible for a foreign company to open a project office without any prior approval. So as a result, presence in India as a foreign company offers limited but useful operational flexibility. The biggest advantage of operating in India as a foreign company is easier exit, and is usually suitable when a foreign company is exploring Indian market and is in the process of crystallizing its India strategy and business plan. The foreign direct investment regulation envisages investment through a company. It could be a new company or an existing company, and limited liability partnership, a new form of legal entity introduced just about 4 years ago and opened up for FDI just about a year ago. I'll discuss in detail FDI in companies in subsequent slides, and I would just make a couple of highlights on LLP, investment in LLP, which requires prior government approval in every case and is granted only for non-sensitive sectors. LLP is required to appoint two individuals as designated partners who are made accountable and responsible for regulatory and legal compliance in India. Out of the two designated partners who have to be individuals, one designated partner must be a person resident in India. The designated partners can be partner either on their own or can be nominees of an Indian body corporate. But a foreign body corporate cannot nominate a designated partner. As a result, LLP, it is not possible to have an LLP which will be a wholly owned subsidiary or wholly owned by a foreign company. Will not be detailing the foreign portfolio investments in this session. So if anyone has any question, please feel free to send over to us and I'll revert on that subsequently. Peter, next slide, please. Coming to foreign direct investment regulations, which are embodied in an annual circular which Government of India comes out in the first week of April every year. There are several very small list of business sectors where foreign direct investment is prohibited, completely prohibited, which is not depicted in this slide, but I'll just highlight so you understand the nature of activities where FDI is not permitted: lottery, gambling, and casinos, a real estate business, construction of farmhouse, manufacturing of cigars or tobacco products, and atomic energy and railway, which are reserved for the government, and even Indian private companies are not allowed to enter. So barring a small list of activities, most activities are open to foreign direct investments. And there are two routes, as you see, automatic route where no prior approval is required, and government route where prior approval is required through Foreign Investment Promotion Board, which acts under the Ministry of Industry and Commerce. So any non-resident entity, with the exceptions and restrictions for entities in neighboring countries such as Pakistan, can invest in India in permitted sectors. And the FDI is permitted in private or public limited companies, limited liability partnerships, as we already discussed. It could be by way of investment in equity shares, or it could be in investment in fully compulsorily and mandatorily convertible debentures, or fully compulsorily and mandatorily convertible preference shares. FDI is subject to two major conditions. One is the pricing guidelines and valuation norms have to be complied with, and the source of funds in terms of KYC and anti-money laundering compliance is also required. So over the years, the scope of automatic route has been expanded and now includes most business sectors such as mining, coal, petroleum, airports, NBFC, and service sectors. So in terms of transition, India has significantly opened and has moved miles away from a closed-door economy that it used to be once upon a time. Next slide, please, Peter. So there are certain sectors which are still subject to ceilings. For example, airlines, telecoms, private banks, and cable television networks. FDI is permitted only up to 49%. In insurance, FDI is permitted only up to 26%. There is a discussion of increasing this 26% to 49% and is increasingly under it has been approved by group of minister. It has not yet been notified. In airports, the FDI has been increased from 49% to 74% recently. In multi-brand retail, now 100% is permitted. Single brand retail 100% is permitted, and in multi-brand retail 51% is permitted. Both though require prior government approval. In petroleum, 49% is permitted. In defense, up to 26% is permitted. So some of the recent liberalizations include single brand retail, which has been development of last 6 months, where up to 100% is approved, is permitted, and that's where IKEA has received approval from Government of India, and H&M is already in the process of receiving this approval. Multi-brand retail sees a restriction of 51% of FDI. Foreign airlines are now permitted to invest in the capital of companies. Earlier, they were not permitted. Broadcasting carriage service has been liberalized from 49% to 74%. And in power exchange, up to 49% has been allowed. These are developments of last 1 year. Peter, we move to the next slide. So most FDI in India is in the form of a company in India. As you see, there are two types of companies which are permitted, the public limited company and private limited company. A company enjoys greater flexibility of operation as it is a separate legal entity and its status is equivalent to that of a person resident in India. Remittance of profit is permitted through dividends. As a wholly owned subsidiary, a company requires minimum 2 shareholders. As you see, a private company has minimum 2 shareholders, a requirement of minimum 2 shareholders. So the second shareholder is usually nominee of the holding company, and that helps the holding company to comply with the requirement of 2 shareholders. So while holding company is legal owner of 100% of shares, its nominee holds 1 share, and that helps holding company to comply with this requirement. At this point of time, local directors are not mandatory. So virtually all directors can be foreign nationals. However, there is a proposed change which we'll discuss later. A person wanting to act as a director in a company in India is required to obtain director's identification number from the Ministry of Corporate Affairs by submitting proof of identity, which is notarized copy of passport, and proof of residence, which could be notarized copy of driving license or a utility invoice. As the entire corporate compliance is now web-based, one of the directors must have a digital signature from a prescribed authority in India. The incorporation process has been simplified, and the steps include seeking approval for name, that is name reservation, and submitting charter documents, which is memorandum of association and articles of association. The minimum capital requirements are nominal and does not really require much. It does not take much capital to set up a company in India. The setup time also is usually about 4 to 6 weeks, provided the charter documents are prepared and submitted in time. In case of a foreign subscriber to the charter documents, when the initial shareholders are foreigners, the charter documents are required to be apostille and consularized in the home country of the subscriber. So that at times we found takes significant time. Next slide, please, Peter. The incorporation of a company is the first step, and the setup process is incomplete without obtaining requisite registrations to enable commencement of business, and of course opening of the bank account. And we found that even opening of the bank account can take at times it takes time, largely because of KYC and other regulations at the bank end, and also this activities at times not planned properly. So a proper planning and professional project management with holistic approach is the key to kickstarting operations in India within desired timeline. Recently, a company approached TMF when even after about 8 months, it could not complete the setup process. They were working with a local firm, and there were coordination and project planning and execution issues. In this slide, you will see various common registrations that are applicable, the income tax registrations. We have a very detailed withholding tax regulation, which requires a separate tax ID. An import-export code without which physical import or export of goods is not permitted. And depending on the type of activities, additional registrations may be applicable, such as a non-banking activity requires additional registration with the regulator. Insurance companies require registration with the insurance regulator. Stockbrokers and other financial sector players require registration with Securities Exchange Board of India. So we have to factor in additional time to kickstart the local operation. Most registrations can be completed within about 1 to 2 weeks, and a large number of registrations can be done in parallel. Some of the registrations have some interdependency. For example, permanent account number under income tax is required prior to opening of the bank account or seeking registration under service tax. Next slide, please, Peter. As mentioned earlier, India still has detailed foreign exchange regulations, though it has been liberalized over a period of time. So while rupee is convertible on current account, there are very few restrictions, again, in respect of gambling and casino activities where foreign exchange cannot be taken out of India. But in respect of convertibility on capital account, which is cross-border investment, there are restrictions. A foreign direct investment, as we saw, is largely under automatic route, and it requires several steps of reporting. The first report is within 30 days from date of receipt of money into India. A company must report to Reserve Bank of India. It must adhere to the pricing guidelines while issuing the shares, and allotment of shares must be completed within 180 days of receipt of money. And as soon as the allotment is made, a separate report of this allotment must be made within 30 days. Along with this report of allotment, the company is also required to submit valuation certificate from a specified merchant banker or a chartered accountant that the pricing guidelines have been adhered to. Cross-border loans are permitted with restrictions on specific end use and conditions such as minimum tenure and cap on the interest rates. A company in India is not permitted to open foreign currency accounts unless they are into exports, and that too, foreign currency accounts are permitted only in specified currencies, but all large currencies are included in that list. So, as a result, cross-border transactions require special attention, and one needs to ensure that they are in compliance. The non-compliance of foreign exchange regulations can invite a penalty up to 300% of the amount involved. So that entails some risk. Next slide, please, Peter. So these are various annual corporate compliances. Board meetings are required once every quarter. And while the ministry has now permitted meetings through video conference, but one meeting is mandatory to be held physically. And the rules accompanying the holding of meeting through video conferences are a bit cumbersome, and therefore usually it would be more convenient if there are two directors who can meet at one place at least once a quarter. So if you have a director, one is in London and the other one is Melbourne, then we have a problem in recording this compliance. Every company must get its annual financials audited and present them at the annual general meeting. So even if a company does not have any significant activity or it's a dormant company, there is no exemption from annual audit. Auditor must be appointed within 30 days of incorporation and at annual general meeting every year thereafter. Post annual general meeting, the registrar of companies must be notified and submitted the audited annual financials. And in case of companies having specified capital, they must submit additional compliance certificate from a practicing company secretary that all the company law compliances are in order. An annual return of the shareholders and directors is also required to be submitted within 60 days from the annual general meeting. In addition, every company that has foreign investment must submit an annual return on foreign liabilities and assets to Reserve Bank of India. Every director must provide general notice of disclosing the director's interest so as to track intercompany or related party transactions. And a director is also required to provide to a company declarations saying that they continue to remain non-disqualified, meaning thereby they have not attracted any disqualification in the Companies Act and they can continue to remain director in a company. Intra-group transactions and subsidiary parent corporate governance issues again need special attention and also trigger compliance under tax laws such as transfer pricing, which are applicable without any threshold limit at this point of time. Next slide, please, Peter. So India is now in the process of enacting new company law, and the lower house of the parliament has already approved this company's bill, so we hope to see the new company law anytime soon. My guess is that the new law is likely to become applicable from 1st April 2014. Under the new law, company must appoint one resident person as a director. All the companies must have financial year ending as of 31st March. So all the financial year must be from April to March. However, a company which is a subsidiary of a foreign company can cite this reason and seek approval from the National Company Law Tribunal to follow a different financial year. However, the tax authorities require every company to submit their tax returns for April to March. So even if a separate financial year is followed for reporting to shareholders, another set of financials from April to March is required to be prepared for tax filing. And at times we have seen this becomes again a challenge in terms of managing two financial close and preparing two sets of financials. Under the new law, one-person company will be permitted, so the issue of having a nominee shareholder will be obviated. Currently, outbound mergers are not permitted, will be permitted under the new law. And specified companies or companies under prescribed class must have mandatory rotation of auditors. Audit partner must change after 5 years and audit firm must change after 10 years. Also, the large corporates will be required to undertake compulsory corporate social responsibility obligations and spend at least 2% of their average net profits on the CSR activities. The corporate secretarial standards also are being given statutory recognition and will entail mandatory secretarial audits for companies having specified size. Next slide, please, Peter.
Well, that's great. Thank you, Nitin. I think this would be a good time to bring in Jane Niven from Jones Lang LaSalle, who can provide us with some real-world insight of what it's like to set up shop in India and some of the challenges that her company has experienced. Jane, can you share some of these examples with us?
Yes, Peter, thank you. And Nitin, thank you very much for a very clear and concise summary of the law as it stands in India with regard to establishing an entity in India. Just a little picture of what Jones Lang LaSalle is to give you a feel for why it is so difficult in India for an organization like ourselves. A lot of people think of us just as a brokerage house, but we perform a wide variety of services across myriad sectors of clients. So we provide facilities management, property management, project management, valuation, consultancy. And every single aspect of our work is affected by the licensing requirements that we face every day in India. The huge number of state, federal, and local licenses that we are required to obtain to perform our services for our clients are quite daunting. And this makes doing business in India extremely difficult. Taking, for example, the issue of catering. I learnt last week that the provision of tea and coffee serving in an air-conditioned environment now requires companies that provide this service a catering license. So, as you can see, even small things like catering require a license in India in a manner that one wouldn't ordinarily expect to see a license requirement. On top of that, just the sheer administration work required to run a company is quite exhaustive. In 2006, we acquired a competitor, and while the acquisition process took less than 6 months from signing of the MOU to completion and handing over of the check, the merger of the two companies, which requires a high court approval, took 18 months to finalize. And the documentation required by the courts filled, I think, something like 25 folders. So while on paper it looks like a very simple place to do business, that is not the case. We also have the issue of trying to manage a vast workforce in India, and while we have, I think, approximately 6,000 people, and it's not vast by Indian standards, the fact that we have people who don't work in our offices, they work on client sites, means that there is another layer of complexity added to what is already a very difficult employment situation. There are taxes to be paid at a federal, state, and local level with respect to your employees. There are issues with a judicial system which is quite favorable towards employees, so terminating employees is difficult. And then on top of that, there is a perceived concern from clients that if an employee of a service provider stays too long on their site, they may be entitled to claim the benefits ordinarily provided to the client employees and not the service provider employees. And this just adds to the problems of doing business. Then there are the basic day-to-day elements of trying to have a foreign organization operate in India. Issues around obtaining the appropriate visas, making sure that people can stay resident, making sure that their taxes are appropriately accounted for, and the list goes on. That being said, in the almost 10 years that I've been part of the Jones Lang LaSalle Group and working in India on a regular basis, I can honestly say that it is definitely freed up. And there are easier ways of doing it. I think Nitin touched on the fact that a lot of the application processes for the setting up of companies are now online, and this is makes things much more. You can process things much more quickly. It's more in line with what we do in other countries, and it just makes life a lot easier for those of us who have to manage the compliance side of things. But nonetheless, it is difficult, challenging, but I think extremely worthwhile. And I hand it back to you, Peter.
That's great. Thank you, Jane. Those are some really interesting situations. Things are never as straightforward as they seem, are they? So now that we've heard about these kinds of challenges, let's talk about how a company can address some of these concerns. Ian?
Much, Peter, and thank you very much, Nitin and Jane, for setting things up really nicely. Now, we can see that India presents significant opportunities for growth, but not without significant regulation and oversight requirements. With all of the regulation concerns and challenges, we feel it's critical that you have a comprehensive compliance and governance programme and system. The concerns below can be mitigated or eliminated with the proper governance process. Now, we'd like to walk you through how ComputerShare and TMF can help you set up this process together. There are many services out there, but we can combine our services to create a seamless workflow using a centralised repository like GEMS. Next slide, please, Peter. Now, Nitin expressed that local knowledge is key in managing some of the concerns listed here. I'd like to walk through how ComputerShare, TMF and a local council, if you have it like Jane, can combine to create a seamless workflow using a centralised, globalised system. Now, we're certainly focusing on India at the moment, but of course all of your domestic and international entity data can be maintained in the systems with checks and balances in place. From formations to maintenance, the actions below can be tracked and managed. Where we comply from a compliance perspective is managing formations, filings and other compliance-related concerns with automation. Of course, many of these actions and concerns may require notifications, not just to you, but to others within your organisation. Once a process like the formation of an entity is initiated, it can kick off a workflow approval process of individuals that need to be alerted to entity formations and other organisational details. We'll go through a few of these scenarios in the following slides. Next slide, please, Peter. Once you have local expertise and the entity information is set up within a system such as GEMS, you can now have an auditable workflow. An organisation like TMF may have the local knowledge and ability to set up entities, but they can certainly be subject to approval process within the database. In this scenario, which is a critical feature within our system, you can see that Adam, which could represent TMF, can create a new entity record. This request is automatically sent to the named approver within GEMS for the entire database, or perhaps down by region. The approver has the option to reject or accept the process, and it keeps an auditable trail as well. In this case, the approver of the entity, Catherine, may choose to get more information on the entity formation from TMF. This is absolutely key in the process in order to prove that you followed the right steps with local knowledge and the proper entity details. Now, once you have this information in your GEMS system, it's key that you can manage the ongoing compliance tasks required to keep the entity in good standing. This is another automated process in GEMS that allows you as the owner of the legal entity to initiate regular data and filing accuracy checks. In a system such as GEMS, you can have different updaters, approvers, and even verifiers of information. In talking about the importance of having local knowledge in India, your verifier in this country may be someone aside from a database administrator. You need to verify that information is accurate well after the formation to reduce any risk concerns within annual returns, filings, appointments, and any other compliance requirements along the way. This again is a process that can be managed by your internal company resource or your local experts such as TMF, and once again entirely auditable as well. Next slide, please, Peter. Now, it's also important that you have a clear method to report this information up and have the ability to take a holistic view of your entity compliance stance across various regions around the globe. You can have a very comprehensive dashboard without having to data scrub and audit each and every entity. With intelligence built into the system, you can run a compliance report to make sure that each entity is set up in accordance with the jurisdictional rules, bylaws or articles of association, and that all the key and relevant data and all the filings have been completed on time. Next slide, please, Peter. We've touched on these, but it's again absolutely critical to emphasise, particularly as more and more regulation comes out, that you have transparency. We found that most of the issues that an organisation has is due to lack of a visibility into what actually is happening in foreign countries like India. When you don't know when individuals are being appointed or filings are changing, there's acute concerns with that process. By having this combined solution and a dashboard to view potential risks, you can ensure that you've done what's required by the jurisdiction and by your organisation. Next slide, please, Peter. Now, we've been focusing a lot on the legals requirements, but it's also key that other departments have access to key entity information. You certainly don't want to provide information that's not verified and accurate, and now that you have, you can share this compliance check data with other key departments. They can also have entry into a system like GEMS to update additional information, such as assets, tax filings, and much more, that will provide an even more valuable global entity management system. The confidence that this information is correct allows other key stakeholders to leverage this information. Now, of course, we understand that each company is different and happy to advise on anything that we've gone through today.
That's great. Thank you, Ian. Now, before we go to some questions, I'd like to remind everyone that we'll be featuring part 3 of our webinar series in June called Doing Business in Brazil, which you can register for at cgs.computershare.com. Some of you have asked about receiving copies of this presentation, and we'll be sure to get it to you at the end of the session. Now, let's go over some of the questions. We have the first question. Because each state in India has its own official language, how does that impact doing business in India or compliance? Nitin?
Yeah, thanks, Peter. Very interesting question. As I mentioned, English is accepted as one of the 2 official languages of business by central government, and most business and compliance is in English. So that avoids any need for any translation. While state governments do conduct their business in regional languages, most tax and other critical compliance is in English. Barring nominal local compliance, such as displaying the name of the company outside the office in regional language, and some of the land record and very local tax-related documents, there is no significant impact of plurality of languages in India on doing business in India. Peter?
Okay, that's great. Second question. In the GEMS application, can you create an org chart of entities in India?
I think that's probably for me, Peter. Yeah, the answer is absolutely yes. Within the GEMS system, once again, as long as the information you have is correct and up to date, you can produce organisational charts by country, by business sector, by region, and you can do it on a regular basis out to a PDF, so that people don't actually need to have access to the GEMS system to be able to gain access to the org chart as well.
That's great. Jane, have you had the experience with the org charting in GEMS?
Yes, we find the org charting absolutely invaluable because we're often being asked, particularly in RFP situations, to clarify the shareholding of our entities in India and elsewhere in Asia Pacific, and just being able to create a PDF which shows every interrelationship within the group is just wonderful. It certainly saves on creating PowerPoint.
That's fabulous. We have time for one more question. How can you ensure that information is kept up to date? I think something that all 3 of us, or all 3 of you guys, can probably address. Nitin?
Yes, Peter. This will require the local, team such as TMF India, which is made responsible for the compliance in India, to work very closely with the client's team in their corporate office, and also, TMF takes up the global responsibility for managing the global compliance track on the GEMS. So the process works with the local team proactively providing the records of all compliances completed as well as all compliances that are occurring. So any change in the law is configured, reconfigured in the GEMS system, as well as all compliances completed are proactively updated in the GEMS system, so which gives one place view of the current status. Peter?
Great. Jane, would you have? Could you address that too? How
I think the criticality. Sorry, Peter. The criticality of having up-to-date information is invaluable, and we rely very heavily on our internal team. So most of our compliance work is done through our finance teams, because that is often where the responsibility sits within Indian companies, and they keep on top of it and feed the information through to us so that we can input it into GEMS.
That's great, thank you. Ian, how about your part?
Yeah, I suppose very, very similar. Just tying the two answers from Nitin and Jane there. That it's important in any system to make sure that all the information is up to date and correct, and using either third-party providers or well-trained inside help and legal counsel within an appropriate system such as GEMS is crucial to ensuring that system is kept up to date and as accurate. And once it's up to date and accurate, all those checks and balances and auditable processes are a benefit on top of that as well.
That's great. I think we're getting close to the top of the hour, so it's probably a good time to wrap things up. I would like to thank our speakers, Nitin, Jane, and Ian, for joining us today and for sharing their wisdom and insights. We hope to see many of you again for Doing Business in Brazil. Like the Doing Business in China webinar, we'll publish today's session to YouTube. If you have other questions or comments for any of us, our emails are listed here, and you can contact us at any time. Thank you very much for joining us, everyone. Have a good afternoon. Goodbye.